A mortgage is a loan secured against your home. Taking out a mortgage is one of the biggest financial commitments you can make because of the amount you borrow and the time you take to repay it. Today, most of us go to work every day to pay on our mortgage. The word mortgage comes from the Latin words mortis, meaning dead, and gage, meaning pledge. So having a mortgage literally means by definition, the pledge of death. The most popular mortgage terms are 30 and 15 years, but you can choose a different term if it suits you and the lender agrees that you can afford it. With a shorter term, you'll have a higher monthly payment but pay less in total. With a longer term, you'll pay less each month but more in total. Beware of having a mortgage term that continues past the age you plan to retire, unless you're sure you'll be able to afford the payments then. You can choose to repay your mortgage in the following ways. If you make principal and interest payments, your monthly payment is split between paying off the loan and paying off the interest you owe on the loan. Or you can choose interest-only payments. This is when your monthly payment pays only the interest charges on your loan and you must arrange some other way to repay the loan. This will usually mean having an investment or savings plan to build up a lump sum to pay off the mortgage when the term ends, or you will be forced to refinance. Speaking of paying off mortgages, did you know that back in the early 50s, 60s, and 70s, homeowners actually worked and saved to pay off their mortgage? After making their last payment, the new real homeowners would invite the neighbors over, ceremonially burn their mortgage papers in the trash can, and then unveil the deed to their home. What happened? Why has this tradition practically stopped? Well, if we look back in American history, in 1929, only 2% of American homes had a mortgage. 98% were mortgage-free. Just 33 years later, in 1962, those statistics had completely reversed. 98% had a mortgage against them. Only 2% didn't have mortgages. In a short 33-year period of time, we went from a nation that was largely debt-free to a nation that was largely in debt. In 1934, Franklin Delano Roosevelt struck the New Deal, and the Federal Housing Administration, or FHA, was formed to assist Americans in the dream of home ownership. Now, when the FHA was created, you would put 80% down on your home, and FHA would finance the other 20% interest only for either 5 or 7 years. When the first 15-year mortgage was made available, people thought, who in the world would take 15 years to pay on their home? Next came the 30-year mortgage, then the 40-year mortgage. And recently, we saw the introduction of the 50-year mortgage in the state of California. 50 years to pay off your home. As a society, we have just come to accept the fact that we may never pay off our homes like our mothers and fathers once did. You may be able to afford the repayments now, but if you borrow a large amount over a long period, think what may happen if, for example, your income falls or you lose your job. Or what if the interest rates rise and your monthly payments go up? How would you continue to make your mortgage and car payment? And what about those student loans you acquired to finance your education? How are you going to pay those back? And what about those other miscellaneous expenses such as electric, water, gas, and even the grocery bill? Do I even need to mention about retirement? The current economic crisis has awakened many people to the importance of rapidly reducing their mortgage term and loan balance. People have become more aware of how mortgage loans work and are keen on getting better rates and terms and cutting down the average payment period. Reducing the average mortgage payment period saves years and a lot of mortgage interest costs. Here are a couple of methods people use for cutting mortgage life and interest costs. They are conventional banking and non-conventional banking. First, let's take a look at conventional banking and what we have been taught through the years. Conventional banking has taught us that the only way to pay off our home early is to either refinance to a lower interest rate, apply additional money to our payments, or to use the bank's biweekly payment program. Not all those programs will work. However, some are costly, and they're simply not aggressive enough considering the non-conventional banking options available today. And they all require more money. Now let's take a look at how our banking system works here in the U.S. We all have a checking account, which is really our spending account, as there is no incentive to keep any money in this account because there is little or no interest paid on this account. So what happens in most cases is that as soon as we get slightly ahead, At least in our minds, we spend the surplus or discretionary money on the latest must-have gadgets, vacations, toys for the kids, or ourselves. Now, at the end of the month, if we are lucky enough to have any money left over after buying the latest must-have items, then we must transfer those funds into our savings account. We have a savings account to try and get ahead or to save for an emergency. The problem with most savings accounts is that on average we earn between 0.5% and only 2%. The system is structured that way so that we have little incentive to keep any money in our savings account. Next, we have a mortgage, which in most cases is our biggest debt obligation. Did you know that on average, a person only stays in their home for 5 to 7 years? And that during the first 5 to 7 years of a typical 30-year mortgage, that more than 80% of the total payments go to the bank in the form of interest? So on average, no one even gets close to paying off their mortgage because by the time we start to get ahead on our mortgage, we move and start the whole process all over again. You see, mortgages are purposely structured so that we pay the majority of the interest in the early years of the loan. Mortgages are designed to keep you in debt for your entire working life and for some people, well into retirement. In the U.S., we have been conditioned to believe that there really is no other way. In the best interest of the financial institutions, we have been taught to believe that we should put all our money into accounts that pay little or no interest. We should make payments on our mortgage that go almost entirely towards interest. And we should avoid the use of savings accounts as we will get almost no real return. This is the trap that most Americans find themselves in, paying lots of interest and having little incentive to save because we get little or no return on our savings. This results in financial frustration and in many cases problems with relationships and sometimes even bankruptcy. I think Albert Einstein had it right when he said those who understand interest are destined to earn it, while those that don't are doomed to pay it. Conventional banking is what I consider the old way of doing business. Using conventional banking methods allow the bank to be in control of your money. Fortunately, we have begun to see in the other countries around the world an alternative solution to conventional banking. In Australia, there has been a financial system in use for years that really works to get their money working for them instead of for the banks. Australian people face the same financial challenges we do here. They just have a better system. More than one-third, that's 33% of their homeowners use a mortgage accelerator program. In the UK, it's about 25%. Were you aware that the average person in Australia will pay off their same mortgage in one-half to one-third of the time as it would take here in the U.S., thus saving them tens of hundreds of thousands of dollars in interest? It's not because they are better at managing their money or that they make more money. It's simply that the Australian banking systems have more innovative mortgage products. Let's take a look at the non-conventional banking methods. Many American citizens have now begun to take a much closer look at mortgage accelerator programs, which are based on the Australian banking system concept. These programs allow us to rapidly pay off our mortgage using existing banking products. What I have found is that it's best to use a company that you don't have to refinance. Use a company that incorporates technology and one that focuses on total debt elimination, not just eliminating your mortgage debt, but all your debt. As I prepare to close, I would like to leave you thinking about this question. What would your life be like if you no longer had that mortgage payment? Better yet, what would your life be like if you were completely debt-free? Now I hope that you have a better understanding of mortgages and how they work to keep you in debt. If you would like to stop giving your money away to the bank using the conventional banking methods and learn more about how to make your money work for you to pay off your mortgage and all other debts, I invite you to go to www.mortgagesarefordummies.com.